Hello, everyone, and welcome again to another financial video podcast. Today, Ted and I are going to be looking at a very interesting company, Bidstack. So they're a company that provides in-game advertising. So it's a relatively not quite new technology. It's certainly picking up, and so much so that actually in the analyst reports, so the compound annual growth of this industry between 2020 and 2024, so this is after taking into account COVID, is due to be growing around 20%. Now, that's a very, very large amount, right, for an industry. Now, of course, it's a new industry. There's going to be a lot of risks and a lot of kind of new players coming in there. It's going to level off at certain points. But this is a really interesting company, and thanks to one of our viewers, Nathan Gaskill, who made this request. Keep these requests coming in hard and fast, and we will shoot out these videos as fast as we can as well. So thank you, Nathan, for your request. Here is your video, sir. So Ted, let's take it away, because I saw we both saw some very interesting things around the finances, particularly in terms of their revenue and their potential. What should we share for everyone here?
Absolutely. So good to see you, Moeed, and I hope you are well. So as you mentioned, Bidstack is this in-game advertising. So you playing Call of Duty, you're walking down an alleyway, there's a billboard on the right, and these guys are going to put the advertising using the technology. They'll put the advertising onto that billboard. So very interesting business model. So let's pull up their annual report and accounts. Now, annual report and accounts, on the front page, we have a rather nice looking car. This could be your company car, Moeed, or it could be mine. So lots, quite interesting in their annual report and accounts, lots of very nice pictures, lots of, very strong on the advertising, really trying to sell the story here. But we are really interested in the financial performance, and it takes a while to actually get through to the financial numbers. They are down on about page 112, I think they are, for this company.
Yes, they are.
So here we are on the financial numbers. We can see that this is the statement of comprehensive income, and massive growth. As you mentioned, this is a growing business. This is a growing company in a growing business. So the top line revenue, they grow from £140,000 to 1.7 million. Okay, so the company is growing. That's over 1,000% growth year on year. The margin, though, is they've actually sacrificed the margin. So this gross margin here, while the gross profit itself has gone up, they're actually making less margin. It's fallen from 24% to 13%. That makes me a little bit nervous, because that should stay constant. So, are they actually having to drop their prices in order to get that revenue? Or is it just that it's a new industry, they're settling down, working out what the industry prices will take? The big issue for this company, though, is the next line down. It's this line here, the administrative expenses, 5 million in the previous year, up to 7.2 million in this year, which means that they are now making an operating loss, both operating loss last year and this year. So really, they're looking to continue that growth rate in order to start to be able to cover those administrative expenses, the costs of, that's the rent, rate, light, heat, but it'll also be effectively the staff who are actually, doing the technology and the sales and the marketing, etc., etc. There's no finance costs really to speak of. That's this line here, which really says that they're not debt funded, they're equity funded. And then we get down to our bottom line, which is a loss for the year. So that's what we find in the income statement. It's trading, it's growing, it's making a loss. The question is, how far do we project this? If it can do 1,000% from 2019 to 2020, is it going to do another 1,000% in 2021? Can they increase that top line to say from 1.7 million to 17 million, for example? And if they can get that up, Can they get the gross profit up to, somewhere around 2.2 million and start to eat into those administrative expenses? But you can start to do the calculation. There's a lot to come before they're actually covering those admin expenses. So they're really going to need to accelerate this revenue in order to be able to turn to profitability. Let's have a look at their balance sheet. So as we'd expect in a company like this, when we look at the balance sheet, the first thing we notice is the difference between the non-current assets. So this is the stuff that they need to run the business, property, plant, machinery, etc. The biggest number is the intangibles, which is their software that they're developing. Nothing really else to speak of. A little bit of property, plant and equipment, which will be kind of computers, etc. They'll obviously rent their offices. And then the main part of their assets is here in the current assets. So we've got trade and other receivables and cash. One thing to notice here, the trade and other receivables. Now, you'd expect the trade and other receivables to grow as your sales are growing, but that's a fairly significant growth rate there. So the trade and other receivables has gone up a lot. If we scroll down and look at the liability side, so down the bottom, the thing we notice with our liabilities is that they have no non-current liabilities at all. So effectively there's no long-term liabilities. There's no debt funding this business. There are the short-term or the current liabilities, things they have to pay soon. And again, we can see a big increase in the trade and other payables. So we see their accounts receivable is going up, their accounts payable is going up. And we kind of expect that because it's a growing business. The other thing to notice on this is looking at the equity here. So there's quite a few lines here. We don't usually see this many lines here. So it's worth just picking out some of the key numbers here. And these two numbers up the top, this is effectively what the shareholders have invested into this business. So this company, they've been raising money and they've been raising additional amounts of money. So this is the share premium account. We don't really have to know the difference between the two, but it's effectively saying they are continuing to raise money. This number here is quite an interesting one. So this reverse acquisition reserve. So if we look at the history of these guys, Bidstack Limited was a private company, and rather than floating, it actually did a reverse takeover into a cash company. So effectively there was a cash company, I forget what it was exactly called. There was a cash company which was listed. It wasn't doing anything. It either had to kind of, do something, or it had to put itself into liquidation and return the money to the investors. And so it bought Bidstack Limited. So the guys who own this company, or the big investors, the CEO and his colleague, they've already seen a significant payoff from the development of their business as this now listed shell company effectively buys it. So this is really goodwill, but we can't have goodwill sitting in the assets, and therefore it sits as a reduction in the shareholders' funds. And then we notice it's sitting on very substantial losses. So it has been making losses for a long time, and it's still making losses, as we saw just earlier. So let's have a look at, and we notice actually just while we're here, the cash figure, just worth bearing in mind here, 2.3 million of cash. They had 3.2 million at the end of last year. The cash has come down, and clearly if you're making a loss of about 5 or 6 million pounds a year, then you're going to run out of cash quite soon if you've only got 2 or 3 million in the bank. And we can look at that if we go and see the cash flow statement. So here is the consolidated cash flow statement. And we see that the loss and the loss here from operations. These two numbers are looking at the working capital are quite interesting, effectively saying the increase in trade receivables. They've made sales, but they haven't collected the money in. They've bought stuff, but they haven't yet paid for it. And significant increases on the previous year. So interesting that those two are very closely matched to one another. So it's making a loss, it's burning cash, And if we just scroll down to the bottom half of the cash flow statement, we can see very clearly how it has been financing that. So here we go, proceeds from the issue of shares, proceeds from the issue of shares. So both last year and this year, it's effectively funding itself through the proceeds from the issue of share capital. Now, when we think about that, that's not a sustainable, it's not sustainable for the long term. And so it's worth just checking what the directors think of that. So if we go up to the directors report, we can see in page 107 that they actually comment on their going concern. So here we see the comment by Donald Stewart, who's the chairman, the going concern statement, and he does say very clearly the group is dependent on further equity fundraising. So if you buy into the story, if you're an investor, then this company is going to, it's going to carry on raising money in order to actually fund the trading so that it can ultimately break even. That's effectively what he's saying here. If we look at the auditors report, the auditors also they reference that. So here we go. This is page 109, the auditors report, and they talk about this material uncertainty relating to a going concern. So the company will be raising money. If the company can't raise money, if the investors say, no, I'm not interested, the company is going to go bust. Now, there's an interesting kind of aspect here because there's a lot of investors who've obviously put a lot of money into this already. The question is, are they going to carry on putting money in? If they're not, then they need to get new investors, which means existing investors are diluted. In order to maintain that, they do what's called a rights issue, which allows existing investors to carry on investing to maintain their own liquidity. But, are they giving good money after bad? Or, is the story there, is this company actually going to start to, make the profits? And I don't know, it'd be interesting to see the investor presentations that the management are coming up with as to, when they expect to actually break even. So going concern is an issue for these guys. And it's also just worth looking at, I thought it'd be quite interesting to look at some of the notes to the accounts. So on page 133, we have the notes surrounding those reserves that we were looking at. So here we have page 133, note number 19, talking about the share capital, how they are issuing shares, but also they are exercising warrants, and warrants is merely the right to buy shares at a future point in time based on certain criteria. And they do actually give a definition of the different reserves and how they arise. So I thought that was quite an interesting one. We notice there's lots of share options being given by this company. So, one of the ways that they're funding it is that the directors are receiving share options. Staff will be receiving share options. That doesn't necessarily reduce the cost. Okay, so it's still reflected as a cost, but it does help on the cash flow. And it's tying people in. There's a vested interest in this company to make this work. So they've got quite a few, quite a few staff. There's about 70 staff in this business, and they are all, have a vested interest in the success of this company. So as an investor, you really feel that, the goals are aligned. The directors are not taking excessive salaries, somewhere between 100. I think the highest paid director is 150,000, which isn't, it is a lot, but it's not an excessive amount. They're not trying to strip the company, and clearly they have a vested interest to make this really work and to become a very profitable. The other thing that's interesting about this company is looking at the trade and other receivables, and here we see the trade and other receivables. It's increased as we expected. So these are these numbers here. We can see how it's increased during the year. Now, if we plug that into our working capital requirement, it suggests to me that they're taking 143 days to collect the money that is owed to them. Now, that may be skewed by, when the sales actually happened. But, if it's anywhere near 143 days, then that's going to put a big strain on the cash flow of the business. If we look at the accounts payable days, that's 82 days. So, we don't know to what extent that's being masked by this company, but if you're a supplier, you want to keep a very close eye on the fact that, are you going to get paid? Are you going to get the payment come through? Not only is it going concern, but also, they are pushing back on their suppliers because they just need to manage that cash flow really, really tightly. What was interesting about this is that when we do this 143-day calculation, it doesn't really coincide, or it doesn't really kind of reflect their analysis of trade receivables. So you don't usually see this analysis in a set of accounts. I think they've included it to really show that most of the accounts receivables are due within 30 days. And they make a statement that, we've collected a significant amount since the end of the year. So while the numbers may say one thing, it's distorted by the growing business. We're on it. We're on our accounts receivable. We're collecting the money in. And it looks to me like they're pushing back on their suppliers. But obviously you can't push back too much, because if you stop paying your suppliers, they'll stop supplying and the business starts to wobble very significantly. So Moeed, that's pretty much it from me. That's what we found. It's it's a company. It's doing particularly well in terms of its growth rate, but it's still making a loss. Here is the share performance. So a big spike around sort of end of 2020, and then it dropped down again. I don't know, maybe there was an announcement there about some big potential. The market cap is 16 million pounds. The actual balance sheet itself, the balance sheet value is about 3 million pounds. That 3 million pounds they're burning through very, very quickly. So unless they raise any more money, that 3 million pounds is gone in a flash. So they're going to be back at the market. Are they worth 16 million pounds? I have absolutely no idea. It sounds like it's a really interesting space to be in. I don't know how competitive that space is, but they've got to grow the business very significantly to start breaking even. I mean, even if they double, even if they grow it by another 1,000%, they're still not making enough money to cover those fixed costs, and those fixed costs will start to grow a small amount as well. So this is real pedal to the metal. They've got to really gas this company up and see if they can deliver on their promises.
Yeah, and that's really interesting, and this is an important point for everyone who is watching this, right? Because we are providing analysis on the finances, and we get a lot of comments from people that say, well, this company has great potential, etc. Let me be really clear and take it from someone that has a huge amount of experience investing and looking at these companies. And Ted's got, over 20 years of doing this. It doesn't matter how great the potential is of the business. If they don't have enough oxygen to survive and they can't acquire more oxygen tanks in the form of investment, then it doesn't matter how great the potential of the business is, or how competitive they are, or how big their moat, or how deep their moat is. It's just not going to survive. So our analysis is to help you look at the fundamentals, which is the finance behind that. Now, this company does have potential. It's high risk, high reward, but keep a close eye on the people who are managing this company to see, do they have the connections? Do they have the tenacity to acquire more money? As Ted says, they're burning through a lot of cash. They're starting to generate revenue, but that's not translating into profit and EBITDA yet. So have a look at that. So this was incredibly useful. Thank you again, Nathan, for your request. Keep them coming. Like, share, subscribe. We will see you on the next video, Ted. Thank you very much.
Good to speak to you again, Moeed.